Dividend stocks are making a comeback, and it's a smart move to explore the best dividend stocks for passive income in 2023. Things have been shifting in the investing world. Last year made many folks rethink their strategies. Trends that were red-hot before, like cryptocurrencies, cloud stocks, and electric vehicles, lost some of their luster. Investors are now placing more emphasis on profits rather than just focusing on rapid revenue growth. Ultimately, a company's main job is to create wealth for its shareholders, and when it comes to generating steady, ideally growing income year after year, dividend stocks are the perfect partners. This is especially great news during times when stock prices have been on a bit of a roller coaster. Now, there's a special group of companies called dividend aristocrats. These are the ones that have boosted their dividends for at least 25 years in a row. They're like gold mines for passive income seekers. In today's video, we're diving into the top 12 passive income stocks you should consider buying right now. But before we jump in, please give this video a thumbs up and subscribe to our channel. We share weekly updates on stock insights and smart investment strategies. These companies have been increasing their yearly payouts consistently through some major historical events like the 9/11 attacks, the 2008 financial crisis, and even the recent pandemic. Let's check out our list of the 12 best dividend stocks for passive income that you might want to buy right now. Big shout out to Seeking Alpha for sponsoring our video, and its analytics. Make sure to get your 14-day free trial of Seeking Alpha. Premium via the link in the description. You can only get the 14-day trial through the link below, so make sure to check them out, guys. Number 12, the Allstate Corporation, ticker ALL. Allstate, an American insurance company, is our first pick. They've been boosting their dividends for 15 years straight. Currently, they offer a quarterly dividend of 89 cents per share, resulting in a dividend yield of 3.12% as of April 19th. Bank of America has even raised its price target on Allstate to $145 and maintained a buy rating due to the company's strong performance this year. Number 11, Extra Space Storage Incorporated, ticker EXR. This company, a real estate investment trust, REIT, invests in self-storage facilities. Recently, Raymond James upgraded it to a strong buy with a $185 price target, taking note of its recent mergers and acquisitions. Extra Space Storage has raised its dividend by 8% on February 16th, marking a 13-year dividend growth streak. As of April 19th, its dividend yield stands at 4.18%, making it an attractive option for passive income seekers. Number 10, Johnson & Johnson, ticker J&J. Johnson & Johnson, a massive healthcare company, is renowned for its wide range of products, from over-the-counter drugs to medical devices. It's a great choice for dividend investors, given its impressive track record of dividend payments. J&J boasts a dividend yield of 2.61% and an annual dividend payout of $4.52. During economic downturns, it remains strong thanks to its diverse portfolio of businesses and global presence. The company has consistently paid dividends for 57 consecutive years and has increased its dividend every year since 1978. Number 9, Consolidated Edison, ticker ED. Consolidated Edison is one of the nation's largest power utilities, serving primarily the New York City area and parts of New Jersey. With a history dating back to 1823, this year marks its 200th anniversary. It has adapted to various technological changes and is currently a leader in the electric power industry. The company is a major producer of renewable energy in the United States, with a focus on large-scale solar capacity installation. Number 8, Altria Group, ticker MO. Tobacco has been around for a long time, and Altria Group is a big player in this industry. They have brands like Marlboro cigarettes, Black & Mild cigars, Copenhagen moist smokeless tobacco, and more. These well-known brands contribute significantly to Altria's revenue and earnings. In the first 9 months of 2022, their revenue grew by 1%. Analysts believe that Altria's non-GAAP adjusted diluted earnings per share will increase by about 4.2% annually over the next 5 years. But here's the kicker. Altria offers an impressive 8.2% dividend yield, which is nearly 5 times higher than the S&P 500 index. and they've been increasing their dividend for over 50 years. With a dividend payout ratio expected to be around 75% in 2022, it looks like they'll keep that streak going. Plus, you can buy Altria shares at a forward price-to-earnings ratio of 9.5, which is lower than the average for the tobacco industry. So it's both a good pick for income seekers and value investors. Number 7. Hershey, ticker HSV. Hershey is famous for its lineup of brands, including Hershey Chocolate, Skinny Pop Popcorn, and Twizzlers Licorice. They had an excellent third quarter with a 16% year-over-year increase in net sales. This performance was so impressive that the company raised its annual revenue and earnings growth guidance for the third time this fiscal year. The cool thing is that Hershey's dividend, which is like a bonus for shareholders, is 1.8%. It's a bit higher than what most companies in the S&P 500, a big stock market index, offer, which is 1.7%. Plus, they plan to pay out just under 47% of their profits as dividends this year, which is pretty good for keeping those dividend increases coming. Now, Hershey's stock price compared to how much profit they're making, that's the forward PE ratio, is 27.3. It's higher than the average for companies in the S&P 500's consumer staples sector, which is 20.9. But that's because Hershey is growing fast and has super famous brands. So, it makes sense for their stock to cost a bit more. That's why we think Hershey's stock is a good buy for folks who want to invest for the long term and get those growing dividends. Number 6. Exxon Mobile, ticker XOM. Exxon Mobile is a big player in the energy business in the USA. They're known for being really reliable, even when things in the energy industry get rocky. They've been giving their shareholders more money through dividends year after year. They've got a solid team managing things, and they know that folks who own their stock want steady income. Even when the energy business has been up and down over the years, Exxon has been smart about how they use their money. Recently, while other energy companies were cutting back, Exxon was investing in things like chemicals and oil fields. Right now, they're in a strong position with their shares trading at less than 8 times what they're expected to earn in the future. Plus, they're offering a 3.4% dividend. Number 5. Stanley Black & Decker, ticker SWK. In 2023, investors expect things to get back to normal for Stanley Black & Decker. Here's why. When COVID-19 hit, people were stuck at home and started doing lots of home improvement projects. That meant they bought a ton of Stanley Black & Decker's power tools and equipment. These things last a long time, so those who bought them in 2020 and 2021 probably won't need more tools soon. As a result, Stanley Black & Decker's sales slowed down in 2022, and it's uncertain how 2023 will go. But we can estimate what might happen when sales get back to normal. Before the pandemic, they made about $6.50 per share each year. If we assume they haven't grown since then, and we use a typical price-to-earnings ratio, their stock could be worth $117 compared to the current price of $78. Plus, here's the cool part. Stanley Black & Decker is a dividend aristocrat. That means they've been increasing their dividend for a long time. Right now, their dividend yield is 4.1%. Number 4. Clorox, ticker CLX. The pandemic really shook up Clorox's usual business. In 2020, their sales shot up because everyone was buying cleaning stuff. Places like schools and offices were cleaning like crazy too. But once people had enough cleaning supplies, sales went down. Also, costs went up because of things like more expensive labor and materials. So, Clorox went from making a ton of money to not as much as before the pandemic. But things will get better over time. The cleaning business isn't likely to suddenly change because of new technology. If you're willing to invest in Clorox now when things are uncertain, you get a 3.3% dividend, which is higher than their usual average. So it's a good option if you're looking for stocks that pay you while you wait for things to improve. Number 3. VF Corp, ticker VFC. VF Corporation is a big clothing company that owns more than a dozen brands like Vans, The North Face, Dickies, Timberland, and JanSport. They cater to various types of people, but focus mainly on leisure and outdoor clothing. People sometimes overlook the clothing industry because it's seen as competitive with small profit margins and trends that change fast. But VF Corp isn't like your typical clothing company. Since they have so many brands, some usually do well, regardless of what's trendy. Right now, the North Face is doing great while Vans are struggling. VF Corp's stock lost a whopping 70% of its value from its highest point. There are worries about supply chain problems, a possible recession, and lower profits. These are valid concerns, but VF Corp has a history of increasing its dividend for 50 years straight, including another increase in October 2022. They've faced economic uncertainty before, and their diverse brand lineup helps them weather the storms. Plus, their shares currently offer a generous 6.9% dividend yield. Number 2, Medtronic, ticker MDTT. Medtronic is a big medical devices company. They're known for their heart-related products, but they make stuff for other medical conditions too, like neurology and diabetes. Medtronic's been a big success story, with their stock rising a crazy 10,000% over the past 40 years. But since 2020, it's slowed down. A lot of that's because of the pandemic. Hospitals delayed surgeries, and people put off non-urgent medical procedures to avoid hospitals and COVID-19. Even though things are getting back to normal, the medical devices industry still has some hiccups going into 2023. But in the long run, this industry looks promising, with an expected total annual revenue of nearly $1 trillion in 2030. As people get older, they spend more on products that help them live better in their later years. Thanks to last year's drop in the stock price, Medtronic's shares are selling at just 15 times forward earnings and offer a 3.4% dividend yield. Number 1, Realty Income, ticker O. Realty Income has an exciting message for dividend stock fans. They call themselves the monthly dividend company. They've been paying a dividend every month since 1994, and they usually raise it a few times a year. They pull this off because they are a real estate investment trust, REIT, that focuses on triple net leases. This is a less risky type of REIT because the tenant handles primary expenses like utilities and building maintenance. 2022 wasn't super exciting for REITs, and Realty Income felt it too, with shares dropping about 10%. They're dealing with higher interest rates and a possible upcoming recession. But their performance in 2022 compared to the rest of the market shows the value of their conservative business model and top-notch tenants. Right now, they offer a 4.6% yield. In conclusion, that wraps up our list of the top 12 dividend stocks for passive income investors. But don't forget, it's crucial to do your homework before you start investing your hard-earned money. Thanks for watching, and best of luck with your investments.